So if you are new to options trading and want to know how to use Wealthsimple options trading but feeling overwhelmed by terms like call, put, strike price, break even, premium, Greeks, etc. Also, if you have questions about what happens if you don't sell the option before the expiry date, how much fees you have to pay and whatnot, then don't worry, I'll explain everything in this video complete with the live example on Wealthsimple Trade, and by the end of this video you will have all the answers you are seeking. Trust me, it's going to be worth it. So first, let's understand all the terms with a live example. I'm taking Google or Alphabet as an example here. So when you search for the stock, you are presented with the options to either buy the stock itself or buy the options. If you choose options, you will see an interface where it says something like on the top, I believe that Google will rise by a certain date. You can then choose whether you think the stock will rise or fall by that certain date. Now, if you believe that the stock price will rise and buy the corresponding option, it's called an call option. And if you believe the stock price will fall and buy the matching option, it's called a put option. In the date section, you can select the date by which you expect the stock to move. For instance, it could be up or down as you believe. Now, for instance, you might say that I believe that Google will rise by March 20, 2024. Today it's March 10th. So once you fill in that info, this gives you the details like the strike price, premium you'll need to pay, and the break-even price. Now here you have the option to choose the strike price. Now when you are choosing the strike price, think of it as making a bet on where you believe the stock price will be in the future. Now if you are buying a call option, you are essentially betting that the stock price will go up. So in our example, we are betting that the Google stock price will rise from its current price of $135.41 to at least $137 by March 28, 2024. Now you also see the premium price here. So the premium is the price you pay to buy the option. It's like paying a fee to make that bet. Now in our case, the premium is $2.68 per stock, but since one option contract contains 100 stocks, you multiply that $2.68 by 100, which is $268 as the total premium for one contract. Now one more thing you see here is the break-even price. So the break-even price is very crucial because it tells us the point at which we start making a profit. Now in our example, it's $139.68. So if the stock price goes above this break-even price, every dollar it goes up beyond that $139.68, that is profit for us. Now below this price we start losing the money, but once it surpasses the break-even point, it's all gain. Now when picking the strike price, it might be tempting to choose which is one below the current stock price, thinking it's an easy way to make money if the stock goes up a bit. However, if you do that, the premium you have to pay for the option will be higher. So here in our case, if we choose the strike price of $134, the premium which we have to pay is $3.73, and the break even is at $137.73. So while it might seem like a quick win, it could end up costing more in the long run because of the higher premium and the break-even price. But of course, there is nothing wrong in choosing the strike price which is below than the current market price of the stock. Now, after understanding how you can buy the options, let's actually understand how you make the money with options, and also understand what you need to do before and after the expiry date. So the strike price is like a special price tag that lets you buy the 100 stocks of underlying asset in case of call option if you choose to exercise your option. For example, in our Google story, if the stock price jumps to $140 on the March 20th expiry date, you can use your option contract to buy that 100 Google stocks for only $137 each, because our strike price was at $137. So in short, your option contract gives you the ability to buy the 100 stocks of Google at $137 no matter what will be the price of the Google stock on March 28th, which is our expiry date. So based on our hypothetical situation, your profit would be $3 for each stock, which is $300 in total. Now this is called exercising your option, but for that you must have enough funds, that is $137 times 100, which is $13,700 in your account to buy those 100 Google stocks. But let's say you don't have enough money to buy those 100 Google stocks, then what? No worries, you can sell your option before it expires on March 28th at 4 p.m. So if the stock price has already gone up past our $137 of strike price, the option becomes more valuable. For instance, if on March 27th, one day before the expiry date, the stock price is already around $140, the option might be worth more than the $268 premium which you paid for it. Let's consider a hypothetical situation and it will be worth $5. So if you sell your option contract at $5, your profit would be $5 minus the $2.68 per stock which you paid for it. And since one option contract has 100 stocks, that's $232 in total is your profit. I have explained more about what happens with your option after expiry at the end of this video if you want to know more. Here you might notice something called ITM and OTM. So ITM stands for in the money contract and OTM stands for out of the money contract. So if the stock price is higher than the strike price, it's called in the money. This means the contract is in profit, but actually it's not profitable yet when you consider the premium cost you paid. So it's always better to look at the break-even price. On the other hand, if the stock is lower than the strike price, it's out of the money, which means it's currently in a loss position. Now let's quickly understand how the options premium price fluctuates. There are many factors which affects the price and that can be understood by the terms called Greeks. Let's see with the live example here. Before buying the option, you can check this from here. Let's start with the delta first. So delta tells us how much the options premium price changes for every $1 change in the stock price. For example, if the option has a delta of 0.45 and the stock price of Google goes up by $1, then the options premium price would increase by $0.45. But does delta always stay the same? The answer is no, it changes, and how much it changes depends on another term called gamma. Now gamma measures how fast the delta changes in response to the changes in the price of the underlying asset, which is in our case Google. Another important metric here is theta, and theta shows how much the options price decreases over time as the expiration date gets closer. So if your option has a theta of 0.09, it means the options price decreases by 0.09 every day, even if the stock price does not change. It's usually in negative and it increases as the option gets closer to its expiring date. You can read about the other Greeks here and understand how it affects the options premium price. Now let's understand all the scenarios on what happens with your contract before and after the expiry date. So the first scenario is that your option is out of money. So if your option expires and the stock price is below the strike price, then the option is worthless. You will lose the money you paid for it in premium. Now the second scenario is that your option is in the money. So if your option is in the money at least $0.01 at expiration, then you can make a profit. And for that you have two choices. The first choice is that you sell the option contract itself to lock in your profits before the expiration date, and the second option is that you can exercise the option, which means you agree to buy the stock at the strike price. Now the third scenario is very interesting. So if you choose to hold the option until it expires and it's in the money, you will need to have enough money in your account to cover the cost of buying those 100 stocks. Now if you don't have enough money in your account to buy those 100 stocks, you won't be able to exercise the option. Now in this case, you should try to sell the option contract before it expires, but if you can't sell the contract and you can't exercise it, it will expire worthless even if you were in profit. So it's very important to keep track of your options expiration dates and plan ahead whether you want to sell the contract or exercise it. So on Wealthsimple Trade, if you have the enough money to cover the expenses to buy the 100 stocks, then the automatic exercising will happen after the expiration date. Just keep in mind that the Wealthsimple Trade charges $20 for that automatic exercising. Apart from that, Wealthsimple charges $2 for each contract buying and selling. So thank you for watching this video. If you like my content, please do like, share and subscribe the channel. If you have any questions, feel free to ask me in the comment section. This video just for an educational purposes, and please do not consider it as any financial advice.